We're joined now by our own Steve Leisman from Jackson Hole, as well as a member of Kevin Warsh's balance sheet task force. Steve.
Thanks, Mike. I'm here with Rajan, who is one of the esteemed economists who's presented here over the years, former governor of the Bank of India, now at the Hoover Institution, former IMF Chief Economist, a lot of roles. But I just have a very simple question for you. What did you think of the speech?
I thought it was very good, given the expectations that had built up. He basically did two things, I think. One is reiterated the fact that he was serious about inflation. He said that before, but he emphasized that once again. But more important, he told people that he knew what it took, that it would take a rise in interest rates to bring inflation under control. He wasn't waiting for AI to come to the rescue. He wasn't waiting for long-term interest rates to tighten financial conditions. He was going to raise interest rates if the time was appropriate. And he didn't give us forward guidance, but he pretty much said, watch the space.
And what, watching this space, what would you expect them? What do you think they should do?
Well, I am in the camp which says they should already have moved, but I'm generally hawkish. I think September will be a serious decision, but it may still be pause. But I think if things go as they've been going, a reasonable labor market, and inflation still way above where the Fed wants to be, no matter how you parse it. What about this
idea that the energy price hike's going to pass through and everything's going to pass through?
It's one damn thing after another, right? That's the explanation for inflation. But it's 5 years of one damn thing after another. And so, yes, if the Fed is really sure that inflation is coming down, it can still wait at the cost of yet another shock potentially, which reduces its credibility more. My sense is they will certainly pay attention to the pace of disinflation, but they might just have to act because it's been too long.
So if you were analyzing this as the IMF chief economist, you would look at the United States, and you guys would do this. You'd say, we're going to look at this country, that country, and you would say the inflation has a structural component to it, not a cyclical necessarily component to it.
Well, the longer it persists, the more structural it becomes, right? And that's the real problem, that yes, you can blame COVID, you can blame Putin, you can blame the oil shock right now, but it all sort of adds up. And yes, we're seeing the end of the trade tariffs in prices, but then now have the oil stuff that's going to come in, especially if oil prices start moving higher because of tightness of supply.
Mike has a question.
I do. Mike Santoli here. Thank you. You mentioned that Kevin Warsh in his speech said that it would take higher rates as the primary tool for perhaps helping to get inflation under control. What does that say about the function of the balance sheet in the past? Kevin Warsh has said perhaps there was something to do on the balance sheet that could bring things more into line, that could help restrain inflation, not to mention what the market might do in response to that.
I think if you parse Kevin's speeches on this, he certainly has said that the Fed has too large a footprint outside of the policy rates. And certainly one part of that footprint is the balance sheet. So I think, without specifying what specifically we're looking at, I think the issue of the balance sheet comes into play from that perspective, which is how do we ensure that the Fed has the appropriate balance sheet?
What can you tell us, Regu, about how the process is going with the task force? Are you close to being done, and what have you come up with?
Well, let's put it this way. We are talking, and we talk frequently.
Okay.
So we're fully engaged. I think Chair Warsh has said that there will be some kind of either the actual report or some disclosure of what the task forces have suggested by the end of the year. And that certainly is a time frame that we're looking at.
Let me just ask, you've spoken publicly about the balance sheet a lot, and you've done a lot of research, and it's really changed the conversation in a way. And your point, I think, if I have it correctly, is that reducing the balance sheet matters a lot, but you want to be very careful about doing it because it could be very disruptive to markets.
Absolutely. So if you want the one-liner on the work, there's a ratchet effect. That if you have a certain size of the balance sheet, the private sector gets used to it.
It's like heroin. That's the way I read your papers. Like, we needed $1 trillion, then we needed $3 trillion, then we needed $5 trillion.
Exactly. So what the paper was about is trying to show the sources of that ratcheting. Why does the private sector become used to higher levels of liquidity, which then means that if you want to reduce the Fed's footprint, that part of that has to be considering the size of the balance sheet.
All right, well, give me the elevator version. Is there a way out?
I think slowly you can normalize, certainly. And I mean, there are so many tools that other central banks are using. So I think the right way to think about it is look at what everybody else is doing and figure out where you want to be in the long run.